Welcome to this explainer. Usually when we talk about retirement planning, the focus is almost entirely on accumulating wealth and generating income, right? But today, we're flipping the script. We are exploring a completely bizarre, highly specific scenario where earning just one single dollar of extra income could cause an absolutely massive financial headache in your retirement.
Okay, let's dive into this. It sounds like a typo or some weird math error, doesn't it? Like how in the world could one single dollar cost you over 2,000? But it turns out it's not a mistake at all. It is a very real, hidden financial trap just lying in wait for retirees. We're talking about a specific Medicare surcharge that catches even the most prepared planners completely off guard, simply because they don't know where the invisible tripwires are actually located.
I want you to really think about this number. $2,297. That is the exact penalty, the surprise bill, a married couple could unexpectedly face just for crossing an income line by a single dollar. No way, right? But to keep that money in your pocket, we need to understand exactly how this system works, and more importantly, how we can outsmart it.
So here is our roadmap for today's explainer. We'll quickly cover the hidden Medicare surcharge, decode your Magi cliff, look at the 2-year look-back rule, expose the widow IRMAA trap, and finish up with some actionable tips to save. Now, I know this topic can feel a bit complex, but don't worry, this explainer is going to give you a clear, step-by-step roadmap to navigate it completely safely.
All right, Section 1, the hidden Medicare surcharge.
We need to define exactly what this threat is and why the government imposes it in the first place. So, standard Medicare normally operates on a 25-75 split. As a beneficiary, you pay about 25% of the program costs for Part B, which covers doctors, and Part D for prescription drugs. The government picks up the remaining 75%. Pretty good deal, right? But if you're deemed a higher earner, the government basically shifts that financial burden right back onto you through something called IRMAA. That stands for Income-Related Monthly Adjustment Amount. Under IRMAA, you could literally be forced to pay up to 85% of those costs. This system was set up over 20 years ago under President George W. Bush for Part B and then expanded to Part D under President Obama. So it's got firm bipartisan backing, which means this surcharge is definitely here to stay.
But how does Medicare actually define a higher earner? Look closely at the specific formula for your Modified Adjusted Gross Income, or MAGI. For IRMAA, your MAGI is your adjusted gross income plus your tax-exempt interest. Yes, you heard that right. Even your so-called tax-free municipal bond interest counts against you here. It's a huge trap. It also includes the taxable portion of your Social Security benefits. Thankfully, it doesn't include the untaxed portion of Social Security, but you can see how easily these different income streams just sort of stack up against you.
Moving on to Section 2, decoding your Magi cliff.
Now, what's really interesting about this slide is that it forces us to completely change the way we think about tax brackets. See, we're all very used to the normal federal income tax system. That system operates like a gentle slope. It's marginal, so you only pay higher taxes on the specific dollars that fall into that higher bracket. Well, IRMAA does not care about gentle slopes. IRMAA operates as a very dangerous cliff. If your MAGI goes over the limit by a single solitary dollar, your entire Medicare premium is subjected to the surcharge for the whole year. There's no phase-in, $1 over, and boom, you fall right off the cliff. Let's look at the actual data for 2026 so you can see this in action. Guide your eyes over to the middle column for a married couple filing jointly. If your joint income is $218,000, your IRMAA surcharge is zero. You're totally safe. But let's say you take one extra withdrawal or earn literally $1 in interest and your income hits $218,001. You just crossed into Tier 1. That one extra dollar triggers a $2,297 annual penalty for you and your spouse. And if you accidentally jump into Tier 2, you're paying nearly $6,000 extra a year. It's absolutely crucial to know exactly where these boundaries are.
All right, Section 3, the 2-year look-back rule.
This is honestly the most confusing bureaucratic rule of the whole shebang, and it's what makes planning so incredibly difficult. IRMAA basically looks to the past to penalize your future using a strict 2-year look-back. Notice how this timeline works. The income you earn in the year 2024, which you naturally file taxes for in 2025, is what the government actually uses to dictate your IRMAA surcharge in 2026. This means a financial decision you make today, like doing a big Roth conversion or selling a property, will sit quietly in the background for 2 whole years before suddenly arriving in your mailbox as a massive Medicare premium hike. It's a delayed reaction that just haunts people who don't plan ahead.
Section 4,
the widow's IRMAA trap. I've got to introduce a really devastating hidden danger here, one that even professional financial advisors frequently miss. Notice how the IRMAA brackets for single filers are roughly half the size of the joint brackets. It's truly tragic when you realize how this math actually works out. When a spouse passes away, the surviving spouse's tax filing status obviously changes the next year from married filing jointly to single. Imagine a couple comfortably sitting in Tier 1 with $240,000 in joint income. After one spouse dies, the surviving spouse might still have roughly $200,000 in income from ongoing pensions and IRA distributions, but now they're filing as single. Look at how this math shifts. That same $200,000 plummets them straight into a massive Tier 3 penalty. Their household income dropped, but their individual Medicare premium just skyrocketed.
Let's move to and see how this builds in Section 5, Actionable Tips to Save.
It's time to pivot from the problem and hand the power back to you. Here is your escape map. First, always calculate your IRMAA room before making withdrawals. This means knowing exactly how many dollars of buffer you have before you hit that cliff edge. Second, maximize the golden window. Ages 63 and 64 are basically the two most valuable years for tax planning. You might be retired with lower income, but since Medicare doesn't start until 65, the 2-year look-back hasn't locked in your initial premiums yet. This is the absolute best time to do Roth conversions. And third, strategically place your assets.
So the crucial point here is knowing exactly which bucket to pull your money from. Notice the assets, things like distributions from traditional IRAs, capital gains, and taxable Social Security. These will aggressively push you toward that IRMAA cliff. But the other assets, qualified Roth IRA distributions, health savings accounts, life insurance benefits, those are entirely IRMAA safe. They literally do not count toward your MAGI limit. Building up these safe buckets gives you the ultimate flexibility to spend your money in retirement without accidentally triggering those huge surcharges. But hey, what if you're already caught in the trap? What if your income 2 years ago was super high because you were working, but now you've retired and your income is totally dropped? Well, the government actually provides an ultimate loophole. If your income dropped recently due to a specific life-changing event, like the ones we're showing here, which includes work stoppage, meaning just regular retirement, you can file Form SSA 44. This lets you appeal the 2-year look-back and ask the Social Security Administration to use your current, lower income instead. It's a highly effective tool that far too few retirees even know about.
So this brings us to the core takeaway of our explainer today. I want to leave you with this provocative question. Is your retirement plan just about accumulating wealth? Or is it about intelligently pacing how the government recognizes that wealth? Because as we've seen today, just having the money isn't enough. Knowing exactly how and when to realize that income can literally save you thousands of dollars every single year. Thank you so much for joining me, and I hope this empowers you to look at your withdrawal strategies in a whole new light.